The role of bonds in your portfolio. Should you own any bonds in 2021? That's what we're going to be talking about here today, so let's jump right into it. Alright, so starting things off with the role of bonds in your portfolio. Now, the general rule is to have the percentage of bonds equal your age. So for example, if you're 25 years old, you should roughly have about 25% of your portfolio in bonds and the rest in stocks. Now, to me personally, that is a little bit conservative, but again, that all depends on the investor and what your goals are. But taking a look at the actual purpose of bonds, the first objective I would say is for capital preservation. Now, what that means is that the money that you put into bonds, you expect to receive back at a later date with interest. So you're not going to really lose a whole bunch of money and you're not going to make a whole bunch of money. It's just to preserve your capital. Now, the second point would be income generation. Basically, the interest that you earn from these bonds are typically reliable and consistent, and you should be able to make some good money if the yield on those bonds are good, which we'll get to that later in the video. And the last thing for bonds is decreased volatility, especially in a portfolio with 75% in stocks. The 25% in bonds will definitely help out with the volatility. Now, the bond allocation by age is a pretty good general rule, but to me, honestly, it should depend mostly on your time horizon, your risk tolerance, and if you're in growth mode or in preservation mode, that being probably the most important topic. Like, for example, if you're 30 years old but have $30 million, I don't think you should be in growth mode. At least I wouldn't be. I would much rather be focused on preserving my $30 million if I was in that scenario. So again, it all depends on your time horizon and in which mode are you, growth mode or preservation mode. Now, as far as in my actual case, I do own some bonds in my portfolio. I actually own about 5%. But as of right now, I'm actually looking to sell off my bond position in my portfolio, and here's why. So let's take a look at one of the ETFs that I own in my portfolio, which is BND, or Vanguard's Total Bond Market ETF. Now, the price right now is currently just a bit under $85, and the forward dividends, or the interest that you'll be earning for the next 12 months, is about $1.56. That puts the yield at 1.8%. And that's not even the worst part. The worst part is the decrease in payouts every month that this ETF is seeing. So for example, in August 2020, I went ahead and received just under 16 cents per share. I had 11 shares at the time. I got about $1.75. But if we fast forward month after month into September, October, November, and so on, we see that the total amount received has been decreasing. And now with the latest payment in March 4th of this year, 2021, I received just under 13 cents per share. I still owned the same 11 shares for $1.42 when I used to be earning $1.75. And if we look even further back, I actually started buying this ETF in about October or November in 2019, and the starting yield was about 2.6%, and now the yield is actually under 2%. Now the question is it worth dollar cost averaging into BND or even just holding BND overall? And to me, the answer is honestly no. When you got stocks like Home Depot, JP Morgan Chase, Johnson & Johnson all yielding over 2% right now at current prices, there's really no reason to be buying BND in my opinion. Granted, there's definitely more risk in investing in these individual stocks, but at least you get a higher upside and a higher starting yield. And lastly, in terms of capital preservation, look at the last 3 months for BND. It's been down almost 4%. Now, I'm not expecting for this holding to skyrocket and make me a whole bunch of money, but I do want it to preserve my cash, so when I want to buy some stocks, I can sell this ETF and use that cash to buy other holdings. But as you can see, the yield is very low and the price return over the past 3 months has been pretty bad as well. So let's take a look at another example, another holding of mine in my portfolio, LQD. Now, this is a investment grade corporate bond ETF from iShares, and the forward interest or dividends right now is about $3.24. If you get the yield on that, that's just over 2% at 2.5%. A little bit better than the Vanguard Total Bond Market ETF, but still, look at the price movement over the past 3 months. It's down to nearly 6%, and that's not something I would consider capital preservation, right? And we're having the same issue here with dividends or interest as well. In August 7th in 2020, I received about $2.95 or just under 30 cents per share. Now, if we look at the forward months in September, October, November, we see the downtrend in the interest that I am earning on these bonds. And the latest interest that I've earned, which was in March 5th, I went ahead and received just under 27 cents per share for $2.69 compared to when I was receiving about $2.95. So again, is it worth dollar cost averaging into this bond ETF? I mean, the capital preservation, as of right now, it's not there, as the bond has decreased in price by almost 6%. And the income generation is also not really there, as the income that I'm receiving every single month has just gone nowhere but south. And if we take a look at stocks like Bristol Myers, 3M, Verizon, you have a much higher starting yield and a stronger upside over the long term. And if you're really concerned with price volatility, I would honestly take a really close look at Verizon. You get a 4.3% starting yield, and the volatility has actually been less than these bond ETFs over the past 3 months. And that's honestly better than investing in these bond ETFs, at least right now. Alright, so let's take a look at why these bond ETFs have been coming down in price. And I think the number one reason, or a top reason for this, is inflation. Now, the projected inflation for 2021 is to be 2.4%, at least that's what the Fed estimates. Now, with higher inflation, there's a higher yield requirement on these bonds for investors to find value in these bonds. Now, let me explain that real quick. So for BND, the yield right now is under 2%. And if we're projecting inflation to be 2.4% for 2021, throwing money into BND would result in a net loss after inflation, right? Because if we have 2.4% inflation and the bond is yielding under 2%, it's going to end up in a net loss, and the purchasing power of your cash is going to be less in 2021. Now, same deal goes for LQD, the investment grade bond ETF. However, they are yielding slightly above the 2.4 projected inflation, but is a 0.1% after inflation really worth it, especially in bonds where there's not really much upside? Honestly, I don't think it's worth it, to be honest. And if inflation does continue to grow, this can continue to drive the bond prices down, hurting your capital over the long term, as the prices need to come down for the yield to increase so the yield can be more attractive to investors. And honestly, if bonds don't start yielding closer to 3%, maybe even 3.25%, I honestly don't think it's worth owning bonds in this market, at least for 2021. Alright, so to hold bonds or not to own bonds in 2021, honestly, it's going to depend on your time horizon. Over the long term, stocks typically outperform bonds. So if you have a longer time horizon, I would definitely stick to stocks. But if you do have a shorter time horizon, honestly, it kind of depends on how you feel the markets will perform in 2021. Because again, bonds do give you protection. If there is a market downturn, you won't lose as much with bonds as you would with stocks. And that ties in with the next point, which is risk tolerance. Now, if your goal is to maintain capital, if you're in capital preservation mode, as I like to call it, then yeah, I think you should own some bonds in your portfolio, have a right allocation that suits best for you to protect yourself against a crash if you really want to maintain your capital. And lastly, of course, is going to come down to the 2021 market and the economy. It doesn't look too good or too favorable right now for bonds, at least in my opinion, with the high probability of inflation and even surpassing that 2.4 projected inflation amount by the Feds. So honestly, it doesn't look too good for bonds moving forward, but at the end of the day, nobody knows. Maybe right now is the perfect time to be buying bonds. Who knows? This is just my opinion, and to me, honestly, I think there are better stocks, better dividend stocks to invest your money in than bonds, at least for 2021. And I think if bonds could start to yield again like 3.25%, maybe they'll be worth looking into later this year. But that's pretty much it. Those are my thoughts on bonds and whether or not you should hold them in 2021. Hopefully the video was helpful, and thank you so much for watching.